Welcome to the daily update, where I'll go over the action in the market for Friday, August 30th, and then we'll see how things look for Tuesday, September 3rd. The markets will be closed on Monday in observance of Labor Day. I hope everybody has a very happy Labor Day, the unofficial end of summer as we get ready to go into the fall season now. We had a late day surge on Friday. Actually, we were above average with volume. Last day of the week, last day of the month, could have been a little bit of window dressing going on there. We really didn't change all that much from a technical perspective. We're still positive, but we have some extreme positive readings. Our list is a little bit longer in the short and intermediate term, but there's still some vulnerabilities as well. And we'll have to see what's the smart money going to want to do once they come back after the 3-day weekend. Are they going to want to buy? Are they going to want to sell? So please be aware that I have a thing called the SPXInvesting Program. There are additional videos and posts and things and courses that I haven't rolled out yet, but I will be rolling out that are available that are not publicly available. So please feel free to check that out and see if it's of interest to you. There's a link below this video that will take you to the website, also to a video. And there's other videos on the YouTube channel and Rumble channel that will explain more about the program. Or if you want to ask me about that, there's an email address here. One benefit that you get from being a member is that as soon as I do the videos, you have access to them, where on YouTube and Rumble, I delay them actually going public. Also, the daily video is the main foundation of the analysis that I do. Now that we're hitting the weekend, I'll be doing the weekend videos, but they're meant to supplement the daily video updates. All right, let's go back and talk about what happened. We did have a higher open. The futures were fairly strong. We were able to get up to R1 at 56.31, and then we started to decline. It was really choppy right off the bat. We went down to the daily pivot at 56.08. We got down to the unchanged level, and we did find support. We went negative there briefly, but we were able to rise back above the unchanged level, the daily pivot in R1, and we closed slightly under 56.50. We were up 1.01%, kind of a surprising move, but just a little bit of action going on to end the week and month. We were above average with volume. That's the first time we've seen that in quite a while. And we're positive in the short, intermediate, and long term. We are overbought. We've got kind of a long list there. And we got the core PCE report that came out, and every part of that report that impacts the markets. And it was treated as friendly. So we're still kind of going with that same basic idea that inflation is coming down. The Fed's going to cut interest rates. The economy's not falling apart. Now, in the upcoming week, we're going to get a lot of employment data, especially on Friday. The employment situation report's going to come out. And that's really what, at least I'm watching, and probably the whole market is watching too, because that's an area that has held up fairly well and justified keeping rates higher for longer. If that starts to fall apart, now everybody's going to freak out and go, oh, we're going into a recession. But the market right now, anyway, is anticipating that will not happen and that we're still hanging in there for a potential soft landing. With the 3-day weekend in the U.S. anyway, we want to just keep an eye on the different geopolitical events because they may have an impact on the markets. Okay, some comments. The Dow did set a new all-time high. It was one of the stronger indexes of the day and of the week. And there was a late day surge. I have the intraday chart I'll go through here in a moment. We're still wondering, this mass index, it's an indicator. It's just one chart. It was triggered as we were going up. Now we've been chopping sideways and we're waiting to see, is this signaling some kind of a reversal? It really hasn't led to anything yet. And the further we get away from this, the less relevant it becomes, but we don't use this chart in and of itself anyway. We look at it in the context of other charts as well. Here's our short-term list, getting a little bit longer again. We have the advanced decline ratio based on 19 periods, the 20-period exponential moving average. We're getting still extreme there, away from the S&P 500. The slope oscillator, we're still looking good from a momentum standpoint, and the Stochc RSI, the Williams percent R, the stochastics, the boom indicator getting kind of far away from that 20-period moving average, and we're still looking really extreme with the 20-period moving average study. In the intermediate term, we have the 50-period exponential moving average looking a little extreme now. We're just barely, it's right on the border with the S&P 500 McClellan oscillator looking extreme. TTM squeeze continues to go up and looking even more extreme. PMO studies, just one area now that we're watching for that, the Sean trend meter, and then the 10-period moving average of the S&P 500 highs minus the lows. On the long term, one new addition, we've got the 200-period exponential moving average. That's a new addition where we've also been following the simple moving average based on 200 periods and the 150. Those are looking extreme. Again, there's two ways to look at this: good momentum or that we're looking overextended to the upside. The scenario hasn't changed, even though we had the core PCE come out. The market's pretty much going with this idea that there will be a rate cut in September, and the Fed has pretty much said that. It's okay, is it going to be 25 basis points or 50 basis points? The dollar was up and interest rates were up, which usually this has been putting some pressure on stocks, at least near the end of the day on Friday. It didn't really have much of an impact. We're back up to 3.91% with the 10-year yield, where after Thursday, we were at 3.87%. We're still inverted with the yield curves. We're getting kind of close with the 10 to the 2-year, but it still has not gone back to being uninverted. We'll have to see with all the employment data coming out and the employment situation report on Friday. Is that going to change things? If the market really likes that, or we see a weaker economic or employment situation report, is that going to change any of the yield curves? We've been waiting well over 2 years with the 10 to the 2-year and about 2 years or so with the 10 to the 3-month, but they're still inverted for right now. Sentiment is now positive. We were at 58, which is positive, and we ticked up to 63. So the market, anyway, after Friday is feeling pretty positive about things, but we're not trending now. Both in the short and intermediate term, our ADX, which is the average directional movement, it's what I use. It's one of my most important indicators. It helps us to determine the condition of the trend. We've dropped below 20. We're below the moving average, both in the short and intermediate term. That means we're not trending. And just looking at a chart, you can tell that we've been chopping sideways. Even with that late day surge that we saw on Friday, we just came up to the top end of the range that we've been in. We haven't really broken out, but we are still below the moving average. So we're below 20 with a weakening trend. With the up day, the bias is positive, and I'm still keeping the momentum at mixed, mainly because we're just chopping around. It's like we're going on a treadmill right now. So I've got kind of a longer list here of economic reports, but not as many charts to show. Personal income came in up 0.3% month over month. They expected it to come in up 0.2%. Last time it was up 0.2%. Personal spending. And the market kind of liked this. It just shows that people are still out spending money. That's good for the economy. It was up 0.5% as expected, where last time it was up 0.3%. The PCE price index was up 0.2% as expected, and the same as last time. On a year-over-year basis, that's 2.5%. This was the one that the market was really focused on because the Fed really watches this. The core PCE price index was up 0.2% as expected, and also the same as last time. On a year-over-year basis, that's 2.6%. So we're under that 3% level. We have not come down to the 2% target that the Fed wants, but we're not necessarily screaming back up either. The Chicago PMI, when we get a reading under 50, that means contraction, and it came in at 46.1, but up from the 45.3 we saw last time. Consumer sentiment came in at 67.9. They expected it 67.8. Last time it was at 67.8. So people are feeling not really worse about things, but not an awful lot better. Okay, here is personal income and spending on a year-over-year basis. We have the income, that's the yellow line, which is just trailing along sideways, and spending on a year-over-year basis still looks like it's declining slightly. Here is the core inflation on a year-over-year basis, actually ticked up a little bit, but we're still below that 3% level, but we have not been able to come down to the 2% level. But the market still liked this anyway. Here's the month-over-month spending where it did increase, showing that folks are still willing to go out and spend money. Here's the Chicago PMI. It's under 50, so it's showing contraction in the Chicago area. Here's consumer sentiment. Ticked up just a little bit to 67.9. Just to give it a little more context, here is the 2-year yield, which has been coming down lately. And typically what will happen is interest rates are coming down. That means across the board, it's less expensive for things, and people tend to end up feeling a little better about that. And here's a breakout where we show the total. That's the blue line, ticking back up a little bit with sentiment. Then we look at how people are feeling right now, the purple area. They're still not feeling really good. There's a lot of unsettled things going on that people are making people a little uneasy. But looking out into the future, the yellow line, they're actually seeing things better down the road. Here's some Isabel Net blog charts. This is the top 10 mega caps as a percent of the S&P, 37.38%. That's why when these stocks really move, that really impacts the S&P 500. And then secular bull market and commodities just getting started. Personally, that's a matter of opinion. But if you look at a long-term chart here, when commodity prices are going up like they did in the 60s and in the 70s, that did lead to massive inflation. And then we saw a real decrease for a long time in commodity prices, and that helped keep inflation under control. The part that I say is a matter of opinion is we don't know if it's going to continue to go up or go down. Something could happen with the economy that would take commodity prices back down, or there's also things that could push commodity prices up higher. So this is a long-term picture of what is happening, at least based around commodities when it applies to inflation. All right, then the probability of a recession based on the yield curve is actually going back up a little bit here. We're above the 60% level for right now. That's the forecast, where it actually in reality has been coming down. And then in yesterday's video, I talked a lot about how folks in the US own a lot of stock. Well, folks in Europe own a lot of stock, but a lot less than what is owned in the US. And the gray line here is at the top. Listed equity as a share of household financial assets. The charts that we were looking at yesterday has this up closer to 40%. But when you compare it to the Euro area and the UK, a lot fewer people actually own stocks in that part of the world. Then the US recession overtakes geopolitical conflict as the number one tail risk, or what's the problem hitting the market now? Even though the market's still anticipating a soft landing, you still have a lot of concerns out there that things might really start to weaken. And that's what most people are really concerned about. Dropping down, but still pretty high in second place, are geopolitical conflicts. And that's why I keep mentioning we want to keep an eye on what's going on, because at some point that may come in and actually impact the market. Not as much with inflation. That's really been coming down. Some kind of credit event. Well, the financial sector has been doing well. We're not really seeing any bank meltdowns at this time. So that's really tapered off. And then those that think that we're in an AI bubble, you're always going to have folks that do that. But that's dropped off too. And then there's some folks that are concerned about an election sweep, meaning that it's all Democrats or all Republicans that take over all the branches of the government after the election. Okay, then the Federal Open Market Committee hasn't begun a modern cut cycle with a 50 basis point move. That's kind of the debate going back and forth now. And I'll be going over these charts in the weekly video to see where we're at. The market seems to be focused on, okay, we're going to get a 25 basis point cut. This is saying, well, what happens if we get a 50 basis point cut? And we don't really know what's going to happen there. And then again, it depends on the context. We're still looking fairly solid economically. Now, that could still change between now and the time the Fed meets on September 18th. But if things stay the way they have been going, it's at least the market is anticipating it'll be a 0.25% rate cut. Just one chart to show you here. This is actually not going to be updated for another week. I've referred to this a few times. I talk about it in the weekly video. This is called the SOM rule. And what happened was, in the previous employment situation report, we went up to 0.53. Now, the line in the sand for this is when we go above 0.5. And this is an economist. You can follow this person on Twitter. Now, they've actually stated in some of their comments that maybe they're not right this time, because anytime we go up above 0.5, that usually signals that we're going to go into a recession. Now, the perma bears are all salivating over this, saying it has a perfect track record and all of that stuff. The person who actually did the research and developed this says, yeah, it's pretty accurate, but because of all the COVID stuff that happened and the stimulus and all the policy with money and all of that, it might not work this time either. We won't know now for another week. This will be updated. We'll see if this continues to go up or if it ends up falling back down. Okay, here's the chart. And it looked like it was just going to be a choppy day right off the bat and just kind of stay that way. We were higher, but really not much of a direction. We got up to R1 and then we started to come back down. We fell below the daily pivot. We actually went negative there for a while. It looked like, okay, maybe we're going to break to the downside. That stopped and we were able to reverse around, get back above the daily pivot, get above R1. And then right at the end, we saw a real surge up. Now, this could have been some buying. This could have also been short covering. But when you look at it on a daily chart, we really haven't gone anywhere. You can see where we closed on Friday. This is also matching up with previous highs that we've seen. And just a little bit positive here before the market opened. And then we did go up right after the economic reports came out, and then just kind of flat now as things close for the 3-day weekend. This is still a concern to us. This is an intraday chart of growth versus value. The red line is still above the blue line. In a more positive environment, we want to see the blue line above the red line. And we're still coming down here with our S&P growth to value ratio intraday. We want to see this going up. Lately, this has been coming down, and that's causing us a bit of concern. So we were up with growth. It had a pretty good day, but not enough to really change things. And when you look at the mid caps, though, growth was up less, and it was up a little bit more with the small caps. So when we look at our end of day charts, not seeing an improvement here. We're actually going down with the growth to value ratio for the small caps. We're going down with the mid caps. We're also flat to still going down with the S&P growth to value ratio. So if the market's really getting set to really move to the upside, we want to see these ratios going up, not down or sideways. We're also unchanged here when we look at the growth of value ETFs, but we're still coming down into the lower part of the rainbow, not showing any real strength. And we did break out above the moving average here after Thursday, but we declined a little bit with discretionary to staples. We also want to see this doing better. Now, it had been improving, but we want to see a continuation of that to be more positive. Large cap growth, we are still above the 50-period moving average. It was up over 1% and holding up for right now. Our trend, this is where we're changing. And you can see where I have it marked here. I actually put this on the chart on Thursday. We just came right up to this level on Friday. We're just range bound right now. And the ADX has picked that up and it's declining and we're dropping below 20. We're also below the moving average. Even with the upward surge that we saw late in the day, the green line's still coming down, but the red line is also declining. So we're still positive, but now we're in a trendless environment or sideways market. And we're also seeing pretty much that same thing on the short-term chart. Below 20, below the moving average, green line on top, so we're positive, but it is declining. And we did pick up with volume just for the last trading day of the week and month there. Sentiment, we declined with the VIX, both with the line chart and the bar chart. And we also declined with the VIX of the VIX as fears coming down. We're still seeing downward momentum as far as the VIX is measured by the MACD. But when you look at a seasonal chart of the VIX, now is about the time when we might see things pick up. September is not historically a good month for stocks. Now, we could always buck the trend and have a really good month, But if you look at seasonal patterns, September can often be negative, and that means the VIX is going up. We did decline here with the equity put call ratio, which to me is a little bit surprising. You'd think ahead of a 3-day weekend that folks would want to put on some hedges in case something weird happens, but we actually went down there. But we're starting to go back up again with the 5-day equity put call, and we're going up with the 10-day. So that's a little more of a slant to the negative side. We're still keeping an eye on the SKU index. The VIX uses at the money options. The SKU index looks at out of the money options. We're still up in this red area. So whatever the market is expecting as far as a big move, it hasn't happened at least yet. And we don't know if that's going to be an upward move, a downward move, a top, a bottom. Everybody has their opinions, and we can make a case for either side currently, but this just tells us something big could possibly be in the works, and maybe it'll develop after the 3-day weekend. We went up with this fair gauge where we're declining with this other fair gauge. So we're seeing some contradiction there. Not seeing any real changes with the risk on to risk off ratio. Ticked up a little bit here, but we have been declining overall lately. And looking at large caps versus small caps with the ratio, this is ticking back up just slightly as the large caps have been outperforming, but we're not really seeing any conviction right now. And we look at the volatility risk premium, still very low overall. All right, the advanced decline line still breaking out here based on price. That's positive. We did go up based on volume, but we haven't broke out above this previous high yet. So that is a negative divergence. When we look at the new highs, new lows, we did see many more new highs and not really many new lows here. But because we've been floundering around here, the 5-day is starting to roll over, but the 10-day is still going up. But internally, this is still showing strength in the S&P. We are extreme positive with the 19-day advanced decline ratio. We remain positive with the 39-day advanced decline ratio. And we're going back up a little bit here with the boom indicator, but we turned back up. We were getting a little bit concerned about this with accumulation distribution coming down. Well, with the upward move that we saw on Friday, that turned it back up. So this is positive and possibly getting a little extreme positive. But you can tell by looking at this that we're not all that far away from the moving average. So I would take this as positive. We are looking extreme with the advanced decline ratio based on price. We advanced, but we're not extreme yet based on volume. A little bit of a negative divergence there. This is positive. The 10-day average of the highs and lows for the S&P still giving us a very, very high reading, showing at least over the short to somewhat intermediate term, good solid momentum. Chaikin money flow continues to go up. That's positive. And we've turned up just a little bit here with the Chaikin oscillator. We've been concerned about this going down. Well, with the Friday move that we saw late in the day, this turned up just a little bit. And it's still positive since it's above zero. We're declining, though, with the vortex. The green line's coming down, the red line's coming up, but the green line's still on top, so we're still positive there. We did break out with the S&P 500 cumulative advanced decline line based on price. And trying to break out a little bit, we are surpassing this previous high right here. So that's somewhat more positive. And the S&P compared to the NYSE advanced decline line, just showing how the broader market is still holding up fairly well. Looking at the NYSE cumulative advanced decline line based on price, breaking out to a new high. When we look at the regular NYSE advanced decline line, also looking really solid there. And our other NYSE advanced decline line also breaking out to a new high. When we break it down based on common stock, looking at the NYSE based on price, setting a new high, also breaking out based on volume. That's looking more healthy. And our advanced decline line studies looking good across the board with all the indexes. So we're just kind of range bound now. We're just chopping around in this range that we've been in the last number of trading days, but still hanging on to being more positive. And we did see an upsurge here with volume. We went back above the moving average. And we're looking extreme with the 20-period exponential moving average as well as the 50-period. Just barely starting to look extreme here with the 200. And these are measured just on the S&P itself, not what's inside the S&P, just the price of the S&P 500. The condition of the 20-period moving average, we're still dealing with these lines here, but we close to the top end of the line. So this is still holding together, and we're still looking pretty good here with our 20-period simple and exponential moving averages, but we continue to chop sideways. We're still above all the plotted moving averages here. So that on a trend basis is still positive. We're looking extreme. We got a little far away from the 20-period moving average with the boom indicator. We're showing an improvement, but not extreme with the 50 or 200. And we are extreme with the Stochc RSI. It had fallen off the list. Now it's back on the list. The Williams %R is extreme positive. We're turning up, but we're not extreme with the CCI 14 or the CCI 20. And we're not extreme here, but we're positive with the force index. And we're looking extreme, but extreme positive with the short term, turning back up, and still extreme in the intermediate short term, and still going up with the long short term stochastics chart. And we are not extreme here with the standard deviations. We're still in the +2 channel. This is extreme. We're back up to 91.8% of stocks in the S&P above their 20-period moving averages. And that is quite a high reading. Doesn't necessarily mean a reversal. You see other times when we had high readings, it just meant we chopped sideways. Well, we've already been going sideways. So is it going to play out a little bit differently? This time, that's what we're keeping an eye on here. And we're still looking good here with our study, showing a lot of stocks in the short term in the S&P are looking positive. We're going up with the 50-period moving average study, the 100, as well as the 200. So on a trending basis, things are still looking pretty good. Intermediate term, we went back up, but we're not extreme with the balance of power, but this is positive. In the condition of the 50-period moving average, we're still above the blue line and the red line. And we're still above the simple and exponential moving averages. The go, no-go system is the darker shade of blue, which tends to be more positive. And we're still dealing with the highest high values. We're chopping sideways. And you can see the blue line, the highest high value here, it's flattened out right now as we go sideways with price. The TTM squeeze, though, just keeps going up. And it's getting quite extreme when we look at it in the longer term. This is the highest reading that we've had on this chart. So we just want to be aware of that. Doesn't always mean a reversal. Sometimes it does, but other times it just means an exhaustion. And we're declining with the ease of movement, but we're still above zero, so it's positive. We're flat with the Erin indicator, but we're above zero, so that's positive. And we're just barely looking extreme positive with the S&P McClellan oscillator. So when we're above zero with this, that means we're going up based on price. And one positive thing is the summation index based on volume has now turned back up. So these are confirming each other again. That was a negative divergence that we were watching. That, at least for right now, seems to have rectified itself. And we're above zero and going up with the NYSE McClellan oscillator. So we're going up with the summation index based on price and volume. That is looking rather positive there. Seeing a negative divergence here, going back up with the Swenlin trading oscillator based on price. We're still above zero, but declining with the Swenlin trading oscillator based on volume. So this negative divergence has not rectified itself yet. Momentum continues to be positive, going up with the PMO, going up based on price, rolling over a bit here based on volume, but still positive. And going back up, but not extreme with the PMOs that are rising. We're still just barely extreme with the buy signals, and we continue to go up and starting to get extreme with the PMOs that are above zero. And these are stocks inside the S&P 500. We continue to be neutral with the Elder's Impulse system for the S&P. We continue to be positive with the parabolic SAR for the S&P. And the slope oscillator just keeps going up, looking rather extreme here. And we're turning back up with the MACD. That's still positive. So all of our oscillators looking really, really extreme with the slope oscillator. Still positive with the TSI. Rolling over a bit in the intermediate term, but still positive, but still going up with our longer term oscillators. Rolling over, but still positive with the Copic curve. Getting back up to the initial extreme area with the Sean trend meter. This is encouraging too. This is not moving average based. This is a different kind of indicator. It measures the buy or sell point and figure signals inside the S&P. This continues to go up and it's not extreme now. So that just means all of the S&P together is still holding up. It's not just a few stocks. We're also still going up with the NYSE bullish percent index. We actually declined a little bit after being extreme with the NASDAQ 100 bullish percent index. We're ticking back up after the ultimate oscillator had been declining. We never did drop below 50, so it didn't turn negative, but this is looking more positive now. And we're going back up with the money flow after being extreme positive. On balance volume is still above an advancing moving average. We're above 50 with the RSI 14 and 9, showing good longer-term momentum there. This is the mass index, and we're waiting to see if something's going to play out with this. It hasn't to this point, and the further we get away from this signal being generated, the less relevant that will become. But the Pring bottom fisher is still working off a buy signal for some reason, even though we didn't really hit a bottom there. We're still looking good here with our weekly chart of the S&P. We're above this R2 level, and for the week, we closed pretty much at the high. The fib extension's coming right back up. We did not set a new all-time high with the S&P. We're close, but not quite there yet. We're coming back up to the 61.8% fib extension level. And we're looking a little more positive again after we were seeing a little bit of doubt here with the hike in ASHI. That's an open candle. That's positive. And the Kegi chart is positive. The Renko chart is positive. And the 3-line break chart is positive as well. Longer term, here's the 150 and 200 period moving averages. Now, they could still go up higher than where they're at right now, but looking a little extreme there. We're still positive across the board and across all the indexes with the Keller market model. We've switched over to a downtrend now with the bonds based on price in the short term. We're negative with commodities and negative with the US dollar across all time frames. And here are the signals. We had a euro, had a bearish MACD crossover, which could be positive for the dollar. The dollar has really been under pressure, but the last few days it's been really bouncing up. We did get the S&P back above 5,600, and then the NASDAQ went above 17,600, 17,700, and then right near the end of the day, the Dow set a new all-time high. And all the sectors ended up being positive, with discretionary doing the best. And we want to see more follow-through with that. And tech, that's another area of growth that had a pretty good day. Energy was up, but up the least. And then communication, that's another growth area. We'd like to see that doing better. Healthcare is defensive and staples are defensive, but they were up on the day as well. And when we look at the S&P with the equal weight, the S&P itself, the weighted index, did outperform, but still the equal weight is holding up quite well. And we saw a little bit of an uptick here with our ratio when we compare the weighted with the equal weight version of the S&P. Looking at the new highs, new lows on the NYSE, still seeing positive scores here. And that's just a daily raw score. Here's the Dow setting a new all-time high. And we switched over to positive with the Elders Impulse system for the diamonds. And we're back above the 50-day moving average, but we're still under this pivot point now with the NASDAQ. And pretty much that same thing with the NASDAQ 100, above the 50-day moving average, but still right at this pivot point. And we've gone from being negative to neutral with the QQQs with the Elders Impulse system. The momentum is still positive. It was starting to roll over, but with the upward move that we saw on Friday, it's turning back up slightly. And the Qs were able to get back above their 50-day moving average. So that's also positive. And here's the fib extensions. We came down to this 23.6% fib extension level. We so far have been able to stay above that. Small caps were up over 0.5%, but still have not really broken out of their range. So when we look at the Russell 2000 small caps, we're still above 50 with the RSI. We're above the 50-day moving average, and the momentum is still positive. And we still remain neutral, though, with the small caps when looking at the Elders Impulse system. The small cap to tech ratio declined a little bit as the tech sector had a bit of a better day than small caps. The mid caps are still above this pivot point, still above their 50-day moving average, but continue to be neutral with the Elders Impulse system. The Wilshire also going sideways with everything else, but still above its 50-day moving average, still in a longer-term uptrend. And our total U.S. stock ETF, also above its 50-day moving average and still holding up quite well, up 0.93%. The staples to tech ratio ended up declining a little bit as tech outperformed staples, especially near the end of the day. But we want to see this really declining. Overall, it has been going back up, and that's been a bit of a concern. Financial sector also up 0.95%. That's good. That means the banks and all the different parts of the financial sector are not falling apart. They're actually looking pretty strong right now. The FANG index, we're still under the 50-day moving average, and we're still underneath this shorter term trend line. We were able to stay above this longer term trend line, but it'd be more positive if we could get back above that. Amazon was up 3.71%, bouncing off of its 200-day moving average. Apple is looking still pretty good, even though it was down 1/3%. And we were up 1% with Google, but below its 50-day moving average, but still above its 200. Microsoft was up almost 1%, bouncing off of its 200-day moving average. Meta was up 0.6% above its 50-day moving average. Tesla, right in between the 50 and 200, it was up 3.8%. NVIDIA, after just getting hammered when its earnings reports came out, it was up 1.5%, coming right back up to its 50-day moving average. And Netflix was up 1.28%. Not quite yet enough to set a new all-time high, but still looking pretty positive now. And then we look at the broad market with a 5-period moving average of the highs minus the lows, still looking rather positive here. But we're seeing a little bit of a disconnect. U.S. stocks have been doing better than world stocks, so we're seeing the short-term relationship start to weaken. We're turning flat here with the longer-term relationship. Oil continues to drop. We want to keep an eye on that if things really escalate in the Middle East, coming in at 73.55. And the dollar, after really coming down, has been bouncing back up, but it's still in a downtrend. We've seen a recent death cross here. We were up with the 10-year yield. We were down with the 10-year based on price. And we're not seeing much of a change here with our growth to value ratios with the Qs to S&P. A little bit of a turn up, but still below a declining moving average with discretionary to the S&P. And large cap growth is not outperforming large cap value. It's actually underperforming. So with the large caps, mid caps, and small caps, we're still declining. Not what you want to see in a good, solid, positive environment. And the S&P to utilities ratio chopping around the last few days actually went up just a little bit as the S&P slightly outperformed utilities. And we're still going up here, even though we declined slightly on Friday with the staples to S&P ratio. We want to see this going down. It's been starting to go back up, which is a little bit of a concern. So what's the outlook for Tuesday, September 3rd? We will be closed on Monday in observance of Labor Day. So I hope you have a good barbecue and go to the beach, do whatever you do, relax. As far as the technicals, we are positive, but we're overbought, but we continue to be range bound. And we're going to get the ISM manufacturing. That's a major report, and construction spending on Tuesday. And then all the different geopolitical things here. And here's the upcoming week's economic calendar. Nothing on Monday, of course. And then Wednesday, we're going to get some jobs data coming out. Thursday will be the jobless claims and the ISM non-manufacturing. And then the big report will be on Friday with the employment situation coming out. And here's just highlighting that the market will be closed on Monday. Seasonality, nothing really much of a change, at least for September 3rd. We're neutral to negative with the Dow, neutral to positive with the S&P. Now, this is the beginning of a new month. So here's September. Just to go back, remember at the end of January, we had an up January, and it tends to follow at 72.6% of the time in an election year. January was positive. We were up 1.6%. And so on average, that means that we tend to have an advance of almost 20%. We've worked our way through the worst 6 months that started in May. Looking at the statistics for September, not really all that good. We tend to be down more than up. We're down or up 44% of the time, down 55% of the time. And then I'll talk about options expiration both the week and then the week after once we get there. Tuesday is kind of a coin toss based on what happened in 2023, whether it's positive or negative. But it's a little more positive here so far in 2024. And then we're looking at all election years together and comparing it with the open field, which is kind of what's happening right now. Whereas oftentimes in September, this is what we see historically. We don't know if it'll play out that way, but we want to be aware of that. And September does end up being, as weaker month seasonally. Also, we see a weaker September, according to this measurement as well. And August through October tends to not perform all that well when you take them together. And then we're done with August now, but if you go back to 1950, the past 20 years, 10 years during an election year, we're always negative on a seasonal basis when we look at September. Again, we could always buck the trend, but we just want to know that this is possible. So what are the warning signs? We're still keeping an eye on these defensive sectors like staples, utilities, and healthcare, and then energy if it blows up because of geopolitical events. Both the 5 and 10-day equity put call ratios are going up, and our growth to value discretionary to staples just not really helping things right now. But we still have a pretty long list. Our smart money indicators, accumulation distribution, starting to get extreme, but looking positive. Chaikin money flow is looking good. The Chaikin oscillator turned up after it had been declining. The advanced decline lines are looking good. The McClellan oscillator and summation indexes for the S&P and NYSE, we're not seeing that negative divergence with the S&P now, so that's looking a little better. We are seeing a negative divergence with the Swenlin trading oscillator, going up based on price, going down based on volume. The parabolic SAR, and I'll be going over the weekly chart in the weekly video, that's positive. We're still positive with momentum. The bullish percent indexes are looking positive. The ease of movement, the money flow, the ultimate oscillator, the Copic curve, the vortex, even though we're coming down slightly with the green line there. The financial sector, and that's encouraging. We're still seeing that looking pretty solid right now. And the momentum for the NASDAQ 100 is positive. So our conclusion, we're still positive. We still remain overbought in the short and intermediate term, a little bit in the long term, but we're range bound. Are we going to break to the upside, break to the downside, or continue to chop sideways? In the short term, we're positive, but that's where we're mostly range bound for right now. We are looking extreme positive with that 20-period moving average study of those stocks inside the S&P, where we're just positive but overbought in the intermediate term, also positive, but looking a little toppy with the longer term moving averages. Thank you. I do hope you have a very nice Labor Day weekend, and I will talk to you in the next video.